Rates in Canada should be dropping almost every single Bank of Canada meeting for the rest of the year. Why? Because the economy isn't doing so well.
Well, Canada has consistently lagged the United States when it comes to economic growth. That divide has widened in recent decades.
Since the financial crisis, house prices in Canada have doubled.
This is the soft landing scenario. It's always been a narrow path, and we have yet to fully stick the landing.
First off, let's tackle why interest rates are so high right now. The main culprit for this is inflation. The Bank of Canada has been hiking rates to try and cool down inflation. When rates are higher, borrowing money becomes more expensive, which in turn should slow down spending and ideally bring down inflation. But here's the kicker. Canadian households are heavily in debt. We love our debt. We love our mortgages, our lines of credit, and our credit cards. When rates go up, it hits us hard because we owe a lot of money. This high level of household debt makes the economy super sensitive to rate hikes. The Bank of Canada knows this, but they've been walking a tightrope trying to balance cooling inflation without pushing us into a recession. This is how much debt we're in. To give you an idea of just how sensitive to rates we are, household interest payments jumped to an annualized $170 billion in just the first quarter of the year, up from $90 billion just 2 years ago. That's a lot of money going towards interest instead of other spending. It's no wonder that the Bank of Canada is very cautious with its rate hikes. Now you might be wondering, where are these rates heading? Well, I've got some good news for you. According to the latest Edge report, the Bank of Canada is signaling more rate cuts this year. And yup, you heard that right, rate cuts. It was just a few weeks ago that the markets were only expecting just 0.25% cut for all of 2024. But now with inflation trending lower and signs of economic slowdown spreading, we're looking up to 1% of cuts. And it might go even higher. Markets are currently expecting the Bank of Canada to lower rates again in July and December meetings with holds in September and October. But again, that could change. And here's a fun fact. There's even talk of a 0.5% cut being warranted at the December meeting. That's a big deal. The 5-year bond yields have fallen by 0.5% in June, and markets are already pricing in lower long-term rates beyond the next 2 years. So why are rates expected to fall? Well, there are a few key reasons. Inflation is cooling down. This is the main reason rates went up in the first place and starting to fade. Inflation is finally cooling down, which gives the Bank of Canada room to start cutting rates without the fear of spiraling out of control. Economic slowdown. Signs of an economic slowdown are spreading. When the economy slows down, central banks often cut rates to stimulate growth. Lower rates make borrowing cheaper, encouraging businesses to invest and consumers to spend. Exchange rate concerns. Interestingly, the Bank of Canada isn't too worried about weaker Canadian dollar right now. Even with the potential downside of a weaker currency, the focus is on supporting the domestic economy. Household debt. With Canadian households carrying so much debt, the pain of high interest rates is hitting very hard. Lowering rates will provide some much needed relief, helping to avoid widespread financial strain. All right, quick pause on this video. Listen, before I say anything, this isn't coming from me, this is coming from the entire team. We need more subs. A lot of our viewers are still not subscribed, so please like, share, and comment below on the type of content that you'd like to see next. Let's dive a little bit deeper into the macro trends that are influencing these expected rate cuts. The latest data shows that building permits surged 20% in April, but the construction activity is expected to slow sharply. The rush to get projects approved before the new regulations take effect has caused a temporary spike in permits. The slowdown in construction activity means that the supply of new homes will be limited, which could keep prices high despite lower interest rates. Calgary's population grew by an estimated 243,000 people last quarter, driven mainly by non-permanent residents. This has put significant pressure on housing demand. With the new immigration rules taking effect, we have seen a slowdown in population already. On a global scale, economic conditions also play a role. Central banks worldwide are monitoring inflation and economic growth. For example, the US Federal Reserve policies influence the Bank of Canada's decision, especially given the close economic ties between the two countries. A synchronized easing cycle globally could reinforce the trend towards lower rates in Canada. For our local viewers and Calgarians, these macro trends have significant implications. The anticipated rate cuts could provide some relief for current and prospective homeowners. Lower rates means lower monthly payments for those new mortgages and potentially some relief for those with variable rates. However, this could also lead to increased competition and more buyers jumping back into the market, driving up demand and potentially even the prices. While we've been dealing with the high interest rates due to inflation and economic policies, there's a light at the end of the tunnel. The Bank of Canada is looking to cut rates throughout the year, which should ease some of the financial pressure. However, this could also reignite demand in an already tight market. For buyers, it could mean more competition, but also more opportunities as the lower rates make homeownership more affordable.